So from a debt market perspective, what would you expect is fiscal discipline is what was the need of the hour, and they have delivered on that. So full applause for the fiscal discipline maintained in the budget. So the debt GDP ratio will decline from 57% given the fiscal consolidation we'll see as the roadmap they have put with the FRBM targets. The debt to GDP ratio will continue declining given the reduction in fiscal deficit. So this is good for the bond market overall. But if you see the net market borrowing is slightly elevated as compared to what it would have been otherwise, because there has been a reduction in small savings borrowing that the government does, and therefore the market borrowing is going to be slightly elevated as compared to what we would otherwise see. So net market borrowing is still declining, but if you were to look at the shift from market borrowing versus the small savings borrowing, it's more skewed towards market borrowing or issuances of bonds, and therefore there could be higher supply, and therefore yields in the short term, as we have seen, have increased a bit. Domestic and global demand for Indian bonds has been high. We have seen, even from Indian institutions like insurance funds, etc., there have been increased demand for government bonds. So if you see ownership as a percentage of total outstanding by public institutions in India, like PFs, insurance companies, etc., is increasing over last year. Also, if you were to look at the foreign buying of Indian government bonds, is been largely positive since that index inclusion announcement came through, barring a couple of months where we saw some outflows, because much of before it got included in index, there was some additional buying that had taken place to ensure that there is some positioning before the deadline kind of comes in, and therefore a couple of months we saw tad outflows, but generally it's been in the positive territory. So we expect this will continue as we have seen the fiscal consolidation pathway maintained, debt to GDP ratio likely to come down. This will boost confidence of foreign investors investing in bond markets, and we should expect the appetite for Indian bonds to increase from here on. RBI has been intervening in the bond market. If you have recently seen, there has been the OMO purchase announced by the government to stimulate demand. The RBI has turned net buyer in government bonds to push in liquidity. So they have been buying bonds, and they have been, because of the foreigners selling, there was liquidity being sucked out of the system, and therefore system liquidity was running in deficit. So what the RBI has done is trying to put more OMO purchases so that they can buy bonds from investors and put in liquidity in the system again. So we expect OMO purchase to continue in the next financial year, and therefore further it will boost demand for government bonds overall. So we have been positive on bond, and we have seen yields decline in the bond market. There are clear reasons why this will likely continue. So there has been growing demand for bonds, as we saw from domestic investors and foreign investors alike. Foreign investors were not present in a significant way in Indian bond markets, but because of the foreign inclusion, we have seen that demand has revived for many of these foreign investors. The RBI's planned LCR, liquidity coverage ratio norms to enhance government is going to enhance government bond demand further. Government's fiscal consolidation will restrict future bond supply because there will be, as we go forward and deficit likely come down, there will be less borrowing by the government, and therefore reduction or lower supply of bonds. So we are talking about, not only next year, but years ahead of that as well. Supply is likely to be restricted. The inflation has been behaving well and trending lower, and hence we can expect rate cuts from RBI. And overall, we expect that, barring any shocks that Trump can bring to the table in form of inflation, there should be a synchronized rate cutting cycle that we may see from global central banks. So overall, our medium term view on bonds is positive, uh, and this budget has boosted that positivity towards bonds.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.